So we should be live. And, you know, one of these times I will get it right. So I'm actually logged into everything I need to log into in order to actually start the stream without any hiccups. But, that day is not today. Okay, so this is the $1 trillion show. And welcome everybody. This is we are, a part of Texture. Executive team, let's call it. And this is where we show people and try to get people to save $1 trillion on their taxes, because that is the mission of the show. So let's jump into it. And this one, got to figure out the right thing to share. Okay. So this is me. I'm Neil. I'm founder, chief tax strategist here at Tax Sherpa. And the mission is to save Americans $1 trillion. That's the very short version. So, Elon Musk is out there. He's saying he's going to cut spending by $1 trillion, maybe $2 trillion. We'll see. We'll get into the news about that in just a second here. We got Lutnick and Bessent. They're saying they're going to raise $1 trillion of additional revenue outside of the existing tax system. So tariffs and whatnot. And that's been throwing the markets into a frenzy for the last few days. And that's all well and good, but I'd rather everybody just keep the money in their pocket. And so instead of sending them the $1 trillion and hoping that they save it, how about we just keep it to ourselves, and then they can go deal with whatever they need to go deal with. So that's what I want to happen. So that's the overall mission here. And that's the question becomes how, right? So we're Tax Sherpa. We help clients plan their tax lives so that they save the most money possible given what's going on in their lives. But there's a limit to how many people we can serve. And as today is April 8th, we're coming up on the 15th here. So, the phones are ringing off the hook, and, people are doing their usual yearly dance with the April 15th deadlines. So there's a limit as far as how many people we can serve directly. However, what we can do is we can scale these same tax saving opportunities or strategies or ways of thinking about things through technology like this live stream, where it doesn't cost us anything for this to go to one person or to go to 1,000 people, right? It's the same on our end, because technology is great like that. We have our explorers group, we have our navigators group, we have courses, we have templates, we have tools, and I'm going to show you a new tool here in just a minute that I built over the weekend. Just because couldn't help myself, basically. So it's these technological levers that we can apply, and if we get everybody in America applying some basic tax strategy, we can save that $1 trillion easy. So that's what we aim to do here. So who am I? I'm the guy who used to owe the IRS $1.3 million. That's how I got into the tax game. So if you've ever been there, I talked to a guy the other day. He hasn't filed since 2011. And that is, so that's 14, or I guess 13 tax years. And that's probably the longest one I've seen to date. I've seen plenty of people who haven't filed 7 years. The reason I got into tax trouble way back when and owed $1.3 million was because I hadn't filed in about 5 years. And but 13 is long. So, we talked about how to get back into the filing compliance and all this kind of stuff. So, if you have tax trouble, I've been there. I've gotten the letters, I've got the certified mail, I've gotten the phone calls, I've got the thing that finally forced me to pay attention was they started garnishing my paycheck. And that's what led me into discovering this whole world of tax planning, tax strategy, because I ended up hooking up with who eventually became my mentor, was a former Wall Street tax attorney. And very different than the way most people do taxes. So that's who I am. It's my little origin story. And the what. So here's a tool that I just made. So I did this over the weekend because as we're coming up on the 15th, not only is it the deadline to pay taxes without interest or fees or penalties or anything like that for 2024, it's also the first quarter estimate date. So quarters are kind of loosey goosey as far as the IRS is concerned. So the quarterly payment dates are, if you need to make quarterly estimates, are April 15th, June 15th, and April and June are not 3 months apart. September 15th, and then January 15th. And then if you're C Corp, that January 15th becomes a month earlier to December 15th. So, um, question is, how much do you pay? Because there's three methods for figuring out how much to put in for quarterly estimates. Method one is ignore it entirely. And this is not what's recommended because it does not save you from interest because the underpayment penalty, if you don't pay enough, and we'll talk about what enough is here in a second. If you don't pay enough for quarterly estimates, then you get charged an underpayment penalty. And the amount varies depending on the interest rates. Right now it's about 7%. Um, so, back when interest rates were zero, it was 3%, which was fantastic. But seven is significant enough that people oftentimes don't want to pay it. So the question becomes, it's like, well, if I don't pay it, I know that the IRS is going to charge me with underpayment penalties. Do I want to, and depending on the state, the state as well. Um, do I want to take that hit and then look at it from a perspective of like, well, I get to keep the cash throughout the year and use it for something. Maybe I can make more than 7%. I don't know. Um, it's a bit of a gamble, and it depends on what you do. I've seen people play that game and lose because they took their tax money and then put it into something and then lost it because they put it into something that did not do well. I've seen people who made good use of the funds and they were able to, increase their business activity and grow faster and do all those kinds of things. And I've seen other people who just kind of put it to the side and just leave it there and just like they just want it there just in case. Better in their bank account rather than in the IRS bank account, which is fair. And just know that if you go with that method, and just know that if there is an underpayment penalty, it's going to increase the amount that you owe by 7% or so. So if you owe 10 grand, it'll be 10.7 basically. So that's method one. Method two is the safe harbor based on last year. So basically, if you pay in at least 110% of whatever the taxes were last year, you're safe for penalties. The problem with that is that this year may not have anything to do with last year. And so it can go either way. You might be way overpaying this year with those estimates. I've done that personally, where I put in 20 grand worth of estimated payments. I ended up with a tax below zero that year because I got sick and couldn't work. It was a whole thing. So it was all, I had to lay out 20 grand and then I got a $28,000 refund, which is okay, but you know, it's not accomplishing anything, right? So you might be overpaying with that based on last year's number, or you might be underpaying. Maybe this year's way better than last year. And even if you do those quarterly payments based on last year's numbers, you're still going to end up with a huge bill at the end, right? So the most accurate way to do it is to use method three, which is based on actual financials. And so that's what the Quarterlizer is. So you can go to this site, you can scan the QR code, it'll take you to the same site, and you just put in your name and email, and then it'll pop up this page. So it's a small business tax estimator. So, like I said, I was at home on Sunday, and I was like, well, I don't want to work because one of my promises to myself this year was to not work on weekends, and I've mostly kept that. Not entirely, but mostly. So but I was sitting there on Sunday and I was like, oh, 15th's coming up, and I just had this idea. It's like I could code this because AI coding is a thing now. And so I did take computer science classes 25 years ago, or even more than 25 years ago now. But so I can like read code and kind of understand what's going on, but I can't write code for the life of me. But I can tell AI what to do, and so I sat down with the AI coding tools for a couple hours on Sunday and was able to come up with this. So it's a pretty simple estimator, but it is light years better than the IRS worksheets because they're really poorly written. They don't take into account a lot of stuff, and um, people don't know how to use them. So so that's one, and it's also a lot faster than trying to go to your tax pro and say, hey, can you run a pro forma for me and charge me $100, $200, whatever it is. Um, and so this is free. It's just one of those free tools. So that's part of the technology that we're trying to get out into the wider world. So it's pretty simple to use. You put in your business side, whether you're a sole prop, single member LLC, an S Corp, or a C Corp. Incidentally, if you're an LLC taxed as one of these other things, then you just choose the other thing. So if you're an LLC taxed as an S Corp, then you just pick S Corp, right? But I'm just going to say I'm a sole prop. Let's say I'm married, filing joint. Today is today because it's going to factor in, it's going to annualize out your numbers. And give date revenue. I don't know. Serena, give me a number. How much have I made year to date on my sole proprietorship here?
120K.
Okay, that's a pretty good number. All right.
Thanks.
All right. And of that 120K in our little business here, Fatma, give me a number for how much I've spent in expenses.
Oh, see, boss. 140K, boss.
Well, I don't want to spend more than I brought in, so let's pick a smaller number.
A lot of people like to say that, though.
It's true. Yeah.
So let's see. 50. 50K.
50. All right. So I
Yeah.
have enough zeros there. Okay. So I brought in 120. I've spent 50. That leaves me with a net of 70. And these other things are, if you're paying wages. So wages paid to owner, which is all, and these two numbers are going to be part of the 50. So maybe I had one employee that I've paid 10,000 so far of the 50. And then other annual income is just outside of this business, how much money is coming in. Could be interest, could be your spouse has a day job, could be, whatever. So let's say my spouse has a job and she's making, I don't know, let's say she makes 60 grand a year. Okay. I'm in Georgia. And this is subject to self-employment tax. So sole props and LLCs are generally subject to self-employment tax. S corps and C corps are not. And then I calculate. So it gives me a tax estimate. So it says, okay, based on based on our numbers so far, revenue is going to be 451,000. Expenses are going to be 188. Employee wages, so that's whoever this person is that I was paying, is going to be 37,000. And so that is going to come out to a taxable income of 241,000. And the 241 is calculated from my adjusted gross income, which is based on my business plus the $60,000, minus my standard deduction, which depends on my filing status, minus my QBI deduction, qualified business income deduction, which is something that a lot of people don't calculate or work into their figures. And that leaves me with 241. So on that, I'm going to be paying 44,000 worth of federal income tax. I'm going to be paying another 48,000 worth of self-employment tax and state tax based on my state of Georgia of 13,000. It's like, okay, that's a lot, but if this client came to me, I'd say we can do way better, but is what it is for now. So based on these numbers, my federal quarterly payment is going to be 21.2, and my state quarterly is going to be $3,400. And now I know what to pay. So it's not a perfect calculator. It doesn't take into account every possible situation. It's not going to do qualified dividends or long-term capital gains, which have discounted rates and all that kind of stuff. But it's a basic calculator that'll get you in the ballpark, right? So so there's that. So check it out. Yeah, check it out at, hold on one sec. taxsherpa.com/quarterlizer, or use the QR code. And Serena, what is your question?
I was going to ask you, so these numbers are more accurate than if the tax return produces the quarterly estimates, like,
Yeah, so like when we do 2024 tax returns, our software will automatically calculate what the 2025 estimate should be, but that's based on 2024, which may or may not be right.
Okay.
So what we're seeing with a lot of people is 2024 has a lot of capital gains and dividends and investment income because 2024 was a good year in the markets. Here we are in 2025, markets haven't been so good. So, if you're paying based on last year, you're probably overpaying, at least so far, in 2025. But yeah, so if you want just the safe harbor, you can use last year's numbers from your tax return. If you want more accurate, you go with actual projections. So that's what the Quarterlizer does. All right, so that is a new tool that is available for everybody to use, and it's free. Like I said, you just put in your name and email, and I'll send you a follow-up email saying how did it work for you, basically. All right, so on to the questions. But before we get to the questions, I'll tell you the answer. The answer to every tax question is it depends.
It depends.
So it depends. What does it depend on? That's always the next question. It depends on facts and circumstances. So what's true for you is not necessarily true for somebody else. So Sammy, who works here in the office with me, we have a hybrid team, some in the office, some remote. And we've been talking about agriculture lately because we've had two, maybe three different clients come in with agricultural type issues. And like the bookkeeping and the tax treatment of agricultural stuff is different because, GAAP has special rules for agriculture, which it would be different than if you bought like a piece of equipment, you know? So it's like I bought a tree, I put it in the ground, and then it sits there for 3 years before it starts to produce fruit, let's just say. It's like how do you treat that? It's like, well, that's different than if you bought a piece of equipment and it started, being useful in your business. And so it's just different rules for different stuff for different situations. And the answer is just because. Like people want like a real like why is it this way? It's like just because. It's the rules that are written by Congress and by, international accounting bodies and whatnot. So just is what it is. Whenever anybody asks me like, well, why is this rule that way? And the answer is because Congress says so. That's it.
That's a good answer.
So, also before we get into the questions, I did want to hit a couple news items that have come up in the past couple days. So, news item number one is the Quarterlizer. So go check out that if you need to do quarterly estimates. Uh, second, the second news item is we got an announcement Friday, I think it was. The another 25% of the IRS is getting laid off. It's not clear if this 25% is included in the numbers they gave us like a month ago, or if this is a new 25%, but either way, it's a large chunk of the IRS is getting laid off. And then also last night, or I think it was last night, the Senate passed the reconciliation bill. And so I've been seeing people online talk about how it's like, oh, this is making the Tax Cut and Jobs Act permanent and it's got this tax impact and all this kind of stuff. It's not true. What it says is that they have legislative priorities, is the way they phrase it, that they want to make the Tax Cut and Jobs Act permanent, and that's part of the forward goals of the legislative session. That's in there, but that doesn't mean that the law was passed. Okay, so this is just a step towards now they got to go back to the House and they got to hash out the differences between the Senate version and the House version. And then that might eventually produce an actual piece of legislation that will affect taxes. But for now, ignore the headlines. This is just the Senate saying, hey, this is what we want to do. We'll see what happens. So that is the news items that at least caught my eye over the last couple days. But then we have questions. So who's up first?
I am. So we had someone that just wrote in and asked, can I give my kids money and write it off somehow, or is it just a gift?
It could go either way. It depends. So
It depends.
it depends. So you could always give anybody a gift up to, I think it's up to $19,000 a year now. So, this happens a lot with grandparents where, if a married couple has two kids, each of those two kids has three grandkids total. So then we have five people that could potentially receive gifts. And so both grandma and grandpa could give 5 times $19,000, which is a lot of money. That's $190,000 altogether. So you can always just give money up to that. And if you go above 19,000, then it's still tax free, but you have to file a form. You have to file a gift tax return because you have a certain amount that you're allowed to give up during your lifetime. And that's called the estate tax exclusion. And so right now I think it's about 13 million right now, but that's subject to change, but depending on legislation. And if you go above the 19,000 for one person in a year, then you got to file a form and say, hey, I'm using up some of my lifetime amount for this year and just notifying everybody of that. So it's still tax-free until you hit that limit, which right now, like I said, about 13 million. So very few people have that issue. If you have kids and they and you want to give them money in a tax advantaged way, then there's a couple other things to think about. So one is that, if you employ kids, then they could be useful write-off. Now, there's a whole lot of caveats with that. So caveat number one is that they have to be minor children, at least age 8, and the age 8 is based on court history of like when can a person be gainfully employed, basically. And so they have to be doing work and they have to be paid a reasonable amount based on that work and all that kind of stuff. So if you set it up right, then a parent paying a child for employment is going to be free from Social Security tax. It's going to be free from Medicare tax. It's going to be free from federal unemployment tax. In most states, it's also free from state unemployment tax. And if you set it up right and the numbers are right, then it'll also be free from income tax. So all that is to say, yes, it can be done. You gotta cross your T's and dot your I's and all that kind of stuff. And then that creates a deduction for the parent in if the parent has an operating business to make that useful. But yes, so it could be a gift. It could be a write-off if you set it up correctly and the parameters are correct. Once they get above age 17 and they're 18 and over, then they become an adult, and then you might be able to get the tax-free on the income tax, but you'll lose the Social Security tax and you'll lose the Medicare tax. You can keep the unemployment tax waiver until they're 21, but that's small dollars. It's, $40 a year kind of thing. So the big thing is the income tax, Social Security tax, and Medicare tax. Um, but in certain situations, even after they're 18, it can be worth it, depending on the situation.
All right.
Right. And for the second question, boss, can I claim repairs on my rental even if it's not making money yet?
So this gets into what's called, whether the asset is in service or not. Um, so you have to be placing it out there for rent, and this is true for all businesses. Um, if you have a business that is not trying to make money, like you're in some kind of startup phase. It's like, hey, we're doing all this stuff. We had a client a couple of years ago who they were opening a restaurant, and it took forever, right? Because they had to buy the building, and they had to renovate thing, and it was like a historic district, so they couldn't do this, couldn't do that, had to get permits. It took like 2 years to renovate this building, and we weren't doing the taxes for it. So when we got the K1 for our client, it was all just zero because what they were doing is they were capitalizing all the expenses because they weren't open yet, right? Which is correct. So, and so whether you have a rental or a business or whatever, if you're not actually offering your thing for sale, then you're not in service, okay? And then you just capitalize expenses until you are in service, and then that you start to take them at that point. So, you know, so it's going to depend exactly on the dates because when we file tax returns, we're talking on an annual basis. So, if you are doing renovations for 8 months, but then in September you list it for rent, then it becomes in service at that point. So, it's gonna depend on where on the calendar it is. Or maybe, you had a tenant January through June, and then they moved out, and then they left the place wrecked, and you had to go in and spend a whole bunch of money, and it took 6 months to do all that. Well, you were in service, at that point, and then so it's a very uh, it gets complicated if there's partial year stuff. If you're really doing renovations and spending money for a whole year, for a whole calendar year, then yeah, you're just going to be capitalizing. So yeah, it depends.
It depends, right? So next question is, can I hire my spouse and what should I pay them to make it worth it for tax wise? So
Yeah, it's rare that it's rare that hiring your spouse makes sense from a tax perspective because if you're filing a joint return, it comes back to you anyways, right? So there might be situations where you'd want to do it because, if you're paying somebody a wage, except for the kids, that's a special situation. If you're paying somebody a wage, there's going to be payroll tax, there's going to be social security tax, there's going to be Medicare tax, and even putting the income tax part aside. So, is it worth paying your spouse a wage in order knowing that you're going to incur that 15.3% tax? Maybe. And the reason why it's maybe is because what a W-2 or any kind of earned income allows you to do is to start, investing into retirement plans. All of the retirement plans, I think all, anytime I hear all, my, brain kind of triggers. But I'm going to say at least most of the retirement plans are predicated on earned income. And basically, the rule is the government's not going to give you a break on investing for retirement and getting a potential deduction unless you have also paid in for Social Security, because that's the biggest issue, Social Security. That's where the government's going broke the fastest. So, if you want to do that and you want to, contribute a lot of money to a retirement plan, then you need earned income. And so there are cases where that does make sense. There are other cases where if the spouses are separated and there's children, sometimes that works out because the credits for the kids outweigh the cost of the wage. So that can happen sometimes, but that's kind of it's a very niche sort of situation. So the general rule is that you could do it, but it's not going to help you any. Um, and then you have to start to things like, well, does one of these special situations start to apply to me? And mostly no, but sometimes yes.
And then sometimes you just gotta pay the spouse anyways.
Well,
Because they want you to.
that's a whole other thing. It's like so I have seen couples where the spouse A is like operating the business, spouse B says I need a paycheck because I'm making a contribution and all this kind of stuff like that. It doesn't help you tax wise, but you can do it. So,
Right.
Yeah.
like,
So for my next question, boss, is
okay.
there such a thing as too small of a business to become an S corp?
Yes. So this is one of those questions. If you ask 10 different accountants, you'll get 12 different answers.
Hmm.
And from my perspective, really the answer is no. There's no business too small. So the reason some people say yes, a lot of people say yes, is because it does increase complexity, right? And it's going to increase, filing costs. If you have taxable profit, and you're taking money out of the business, you might need to set up a payroll system. The reasonable compensation is a whole other discussion. But the all of those things are manageable, and in most cases, it is worth doing the S corp anyway on a tax savings kind of calculation, even with all those other expenses. So, you know, there are times, depending on the numbers involved, depending on the filing situation, depending on the family situation, that maybe you're better off staying as a partnership, or you're better off being a sole proprietorship. But most of the time, it's going to be S corp. It's literally 92% of the time that S corp comes out better, and even with the added complexity and added fees. So because of that, I'm much more on the S corp side than a lot of other accountants. I've heard other accountants say it's like, oh, you need to be making 50 grand. I've heard one guy say you need to be making 200 grand before S corp makes
Oh,
sense. It's like
oh wow.
there's no way that is true. But different people have different opinions as far as like what is the value of that added, you know, complexity and everything versus the tax savings. And also depends on how much you're paying to get your taxes done. So an S corp might cost you 2 grand to file taxes. I was talking to a guy I know is in a navigators group, and he was going back and forth with the S corp thing, and his accountant's going to charge him $2,000 for the S corp return, which is kind of standard. Um, you know, every year these surveys come out in the tax professional world is like how much are people charging for different kinds of things, and corporations are more expensive. That's just how it is. But even so, it's usually worth it.
Understood. And then I've heard recently from a route call 30K. Someone said you have to be making like 30K and above to
Yeah.
start an S corp. What do
Yeah.
you feel about
So
that?
I mean, everybody has their own opinions.
Yeah.
You know, for me, knowing that it's not so, knowing that when we talk to our clients that we're implementing tax saving strategies along with the S corp, our math works out a lot better than people just say, well, if you just do that, then this happens, because they're not doing steps two, three, and four. Um, but if you do steps two, three, and four, then it works out better. So, yeah.
Understood. And looks like we have another question that came in, and someone wants to know what's something people always forget to do.
To deduct.
Yep,
Uh, I mean, there's a lot of stuff.
I know. Yeah.
So, um, I'll give you a few. So one is the child care credit. So for kids from birth through age 12, if you pay for camps or after school stuff or, just any kind of child care activities, and both parents or all parents, if it's a single family, or single parent household, then just the one, or if it's married filing joint, if it's both. If both parents or the head of household has earned income, so we're back to that again, then you get a tax credit for the child care expense. Also, if the child is disabled, the 12-year-old limit goes away. It could be lifetime. So, um, so that's one that people forget a lot. Residential energy credits, people forget a lot. So residential energy credits were revamped under the Inflation Reduction Act, and so there are a lot more generous credits now as far as like if you do energy efficient windows or doors or appliances or heat pumps or stuff like that. And that's a separate subcategory than putting solar panels on your house, which is also under the same credit structure. But there's different parts to the credit. So that's one people forget a lot. The you know we I don't know why it is, but we're seeing a lot of businesses lately that are really skimping on their expenses, and it's just a little bit baffling, but it is something people do
Mhm.
because they're not keeping good track of what's business expense and what's personal expense, and so they kind of end up just saying, "Oh, well, this is all just everyday stuff and only these couple things that I can clearly identify are business." So that's more of an organizational problem. um, so I was just working on a return earlier today where it's a chiropractor, and it's like his expenses were 5% of his revenue, and it's like, yeah, that seems wrong. It's like there's no rent here. Are you doing it out of your house? I mean, maybe. um, and even if you were doing it out of your house, then you want to take a business portion of your house. But most chiropractors have an office and they go to a place and there's, $2,000 a month of rent or whatever it is. So the lack of organization on the small business side drives a lot of undercounting of expense. And that's just kind of a general thing. So it's not like just one thing. Um, what else do people forget? I mean, that's a good start, but uh, oh, something that's been coming up a lot recently is rental property insurance. And there's a reason for this. The reason is that it's part of their mortgage payment, but a lot of mortgage companies do not report the insurance escrow portion. Some of them will so it depends on the bank. So some will list just the interest that was paid in the loan. Some of them will list interest and property taxes that were paid. Some of them will list interest and property taxes and insurance. And some of them don't, so a lot of times we have to go fishing for whatever the insurance premium is for that rental property. Because pretty much every rental property has insurance, like a landlord policy at the very least. But you got to make sure that gets captured. And because it might not be on that form, a lot of people forget about it. So yeah, there's a good list of four to
Yeah, I think
start
that's
working
pretty
on.
good. Yeah.
Yep. So
Yeah,
what's next?
so Eva, so we have a questions from one of our clients. He said, "What is something I should do now that will help me next tax season?"
It's, you should sit down with your tax strategist. That's what you should do.
For sure.
Uh, so I mean that's such a general question. It's hard to answer because it all depends. It depends on how you're filing. It depends on if you have kids. It depends on what your sources of income are. It depends on what your expenses are. So it's really general. But the overall idea is you want to get organized. If you have any kind of business element to your business life, to your tax life, you want to make sure that's organized and separate. And then you want to sit down with a tax pro, a tax professional who specializes in planning ahead rather than just filing the forms. And sit down with them, so it's April, and April's generally pretty early in the year. So maybe in June, start sitting down and say, okay, year's halfway over. Here's what we're looking at tax wise. I think business is going to be like this. I think I'm going to get a new job. I think I'm going to get a bonus, whatever the case may be. But just start planning ahead. And then that'll put you in a much better position come the end of 2025, rather than having to scramble at the end and say, oh, well, we're now into January of 26. It is what it is. You know,
So being proactive
be
with your
proactive. Yes.
accountant. Okay. Understood. So next question is there a way to prepay taxes to lower my income this year?
Sort of. So this used to be much more useful. So if you pay state taxes, like you live in one of the non-income tax-free states, which is, I think there's, uh, well, Mississippi just passed some legislation saying they're going to be tax-free, but that's not kicking in until 2030, I think it is. Um, anyway, let's say you live in one of the other 42 or whatever states. Then, if you pay your state income taxes during the year, then that counts as a state and local tax deduction. The problem is that under the Tax Cut and Jobs Act regime that we've been under since 2017, is that that amount is limited to $10,000. So it used to be unlimited. And we used to have situations where somebody had a big tax bill, and so they're going to have a big federal bill, and they're going to have a big state bill. We wanted to make sure to get that state bill payment in before 12/31 in order to get that deduction on the federal side and the itemized deductions. That's not as useful anymore. Now, prepaying your penalties, like we were talking about with the estimates, there is an underpayment penalty if you don't pay enough. So there's that, and that can be, depending on the numbers, could be, a decent chunk of change. And so that works. If you are doing if you're in a state that has elected pass-through entity taxation and you have a pass-through entity, you can do it that way. So that was created as an end run around the limitation on the state tax issue. So this was the state started doing this about 5 years ago, and it was officially recognized as valid by the IRS, I don't know, a few years ago. So more states are doing it now, where let's say you have an S corp, and let's say that you're going to get $100,000 worth of taxable income from this S corp, and you know that, okay, I live in a 6% tax state. That's going to be $6,000 worth of state taxes. Now, that's not going to help me on my personal tax return because I'm not able to itemize because of the state and local tax cap and the fact that standard deductions are larger and blah blah blah. But if my state has passed through entity taxation, then I can have the S corp pay the 6,000 on my behalf, and then that becomes a deduction at the corporate level and lowers my taxable income from that S corp. So if you're in one of those states, and you can Google it and find a list, then that can help by lowering your income for tax purposes. So that is a tax payment that is prepayment. But if you are talking about prepaying federal in order to reduce your federal taxes, then no, that doesn't work. But if you're prepaying state, then maybe if you go through one of these channels.
Understood.
Oh. So for my next question, boss, if I house hack, like live in one unit and rent the rest, how does that affect taxes?
Yeah. So If you're renting, whether it's a room or you have a duplex or triplex or something like that, that's a rental activity, and you should report it as such. So you'll have usually that's going to be a Schedule E, which is rental income, also royalty income. A Schedule E page one, and then you're going to report your rent received. You're going to report your expenses, and then if you're house hacking, you got to be a little bit careful in that are you splitting utilities, or some things purely for the tenant and purely for you, and you just got to keep everything clean as far as who's paying for what. Because if it's something that's purely for you and you're the owner and you're living there, then that's not a deduction. If it's something purely for the tenant, then that is a deduction. If it's something that's shared, then you got to apportion that appropriately for however much use is attributed to the rental portion or the personal use portion. The other thing is that the question becomes, do you want to depreciate? So depreciation is where you write off a piece of the structure over time. And in a house hacking situation, sometimes you do, sometimes you don't. So um, if you depreciate, you get a tax deduction in the current year. So let's say you have I don't know, let's say a $500,000 house and it's split in half, right? Half you live in, half the tenant lives in. So $250,000 worth of structure is a portion to the tenant. Now that's going to be a $10,000 deduction every year if you depreciate it. Okay, great. However, the question comes is like when you sell that property, what happens? Because if for a personal use, you get as a single person, you get a $250,000 exclusion of gains, or if you're married filing joint, you get $500,000 worth of gains excluded from taxable income. So, you bought this place for 500, you sell it for 800. If you're married filing joint, tax free. Great. You have to live there for at least 2 years. Um, and then, but if you've taken a depreciation expense in previous years on a portion of that, you have to recapture that and pay 25% tax on that. So, so it depends on your plans. Depends on how long you're going to keep the property. Depends on what those things are worth, now versus later. And it depends on the numbers, of course. So that's a little wrinkle of complication that comes in when you're doing a house hacking sort of situation. If it's just a rental property, then yeah, you take the depreciation, um, and then you don't have that question of trying to get it's the 121 exclusion. So yeah, so it depends.
And so the 121 is for the rental properties only,
The
you said?
the 121 is for the personal property exclusion of 250 or $500,000 of gains.
Okay, understood. Um, all right. We have another question that came in. Someone wants to know if I pay for my kids' college, is there a way that I can write all of the payments off?
All of it, no.
Right, yeah, no, sorry.
So so there's two different things for colleges. So one is there's the American Opportunity Credit. So the American Opportunity Credit is a dollar for dollar credit up to $2,500, and that applies for 4 years maximum. So if somebody goes to undergraduate for 6 years, then you only get four for American Opportunity, and it's dollar for dollar, and there's an income phase out, which I think it's like $180,000. I'd have to check, but if you make too much money, you don't get the credit basically. So that's the American Opportunity Credit, and it is partially refundable, meaning that even if you don't have any tax liability, you can get $1,000 back from the American Opportunity Credit, which actually screws up a lot of people. So what happens is that kid goes off to college, and let's say works a part-time job somewhere. Maybe doesn't even work a part-time job somewhere, but they get a form from the school called a 1098-T. That's a tuition statement, and it shows however much was paid. It shows any scholarships that might have applied. Um, but whatever the difference between those two, plus books and supplies and things, are eligible for the American Opportunity Credit. So somebody at school says, "Did you know if you file your taxes and you use your tuition statement, you can get $1,000 from your taxes?" And the kid says, "Really? That sounds great," because they're 18, they don't know anything. And the part that gets screwed up is that is only true if you claim your own exemption. So exemptions don't really exist anymore, but basically you're saying I'm independent. I'm not independent of anybody else, and therefore I get to claim this credit. Because the credit goes to whoever claims that social security number as being supported. So mom and dad are, 1,000 miles away, let's say, and they don't know any of this is going on, and they go to file their taxes, and they say, "Here's our form. Here's our son who's at university of whatever." And we say, "Great," and we put it all in, and then it gets rejected by the IRS because, oh, this Social Security number has already filed a tax return. And then we call up, little Jimmy or whoever, and we say, "What are you doing?" It's like, "Well, I got $1,000." It's like, "Yeah, but you just cost your parents 3 grand between the other dependent tax credit and the $2,500 they would have gotten for the American Opportunity Credit. So you got your $1,000, but you cost your parents three. That's not smart. You could have made a deal with your parents maybe and gotten the one, and they still could have gotten two. I don't know. So that's a whole thing. Obviously, I've read into that a time or two. Uh,
Mhm.
so that's credit number one for school. Credit number two for school is the lifetime learning credit. And this is not a dollar for dollar, it's a 20% deduction. It applies for any kind of graduate school or any kind of, um, you know, maybe non-degree course at an accredited place. Or if you've used up your American Opportunity Credit 4 times, then the lifetime learning credit's your only option. So there used to be a tuition and fees deduction, but that went away back. I think Tax Cut and Jobs Act wiped that out. So lifetime learning credit's non-refundable, meaning that if you don't owe any taxes, you're not going to get any money out of it. But if you've used up the other things, or you're in grad school, or one of these other things that excludes the American Opportunity Credit, you might as well take it. But yeah, it's so the way the tax code is written is that they want to encourage people going to secondary or I guess tertiary education, but not too much. So there's limits on who can get it by income, there's limits on how much you can get, and there's limits on how effective it is versus dollar for dollar or 20%. So given that school costs, $100,000 a year or whatever, depending on where you go, you're definitely not going to get all the money out of it, for sure.
Alrighty, boss. So for my next question is, can I hire my spouse? Let's see. Can you explain in plain terms why some people pay themselves low salaries and high distributions?
Ah, yes, because they pay less tax. That's why. So this gets into reasonable compensation with S corporations. So the reason S corporations are so much better than everything else is because the profits coming from an S corporation, you do pay income tax on them, but you get the qualified business income deduction, which could be 20% of whatever the income is, and they are not subject to self-employment tax, which is Social Security and Medicare. So it could be a 35% difference between S corp profits and paycheck. Okay, so huge incentive to take money through an S corp. Now, because of that, there's this reasonable compensation rule, and the reasonable compensation rule basically says that on money coming out of a S corporation, you have to pay yourself a reasonable compensation first before you start taking any profits. And there's a whole lot of caveats that get embedded into that statement. And so what some people do is they say, "Well, I'll just pick a number, $2,000 a month, $3,000 a month, whatever it is, and I'll pay myself that, and I'll take the rest as distributions." And that is not a defensible position. Let's call it that. So red flags for the IRS when it comes to reasonable compensation audits are no salary. But even more than no salary is low round numbers. So like 2,000 a month, 3,000 a month. And the reason for that is because nobody makes exactly $2,000 a month anywhere. So even if whatever that hourly rate would be, let's say that there's 173 working hours in a month. So 2,000 divided by 173, that would mean you're making $11.56. Now, maybe there's somebody out there making $11.56, but the chances that they land on exactly $2,000 a month are almost zero. So, you know, so that is a bit of a red flag for reasonable compensation purposes. And, it's also you have to define what reasonable means. And reasonable is going to depend on what you're doing. So there have been many approaches to figure out what is reasonable. And one approach that has worked in court when these things come through audit and people contest them and go through tax court is a an analysis of time spent. So the thing about being a business owner is that you're not doing one thing. It's not like you get hired to be a business owner and that has a salary, right? You're doing sales, you're doing marketing, you're doing admin work, you're doing, planning, you're doing whatever the business actually does, hopefully more of that than the other things, but it depends on the size of your business. If you're a one-man show, then you're doing all those things all the time. And you might be spending 10 hours a week doing the actual thing that you're providing to the marketplace, and 30 hours a week doing all this other stuff. Just kind of depends on the structure of your business and its place in the market and all those kinds of things. So if you track that time over time that you spend in each of those different business activities, then you can come up with, okay, like as an office admin, I would make this amount per hour. As a technician doing my thing, I would make this amount per hour. As a sales and marketing consultant, I would make this amount per hour. And you come up with a weighted average of whatever it is that you would make between all those different things, given the time spent in all those different things, and you pay yourself based on that. So that's an approach that has worked. There are software tools that can help you out with that. Like, so one is called RC Reports that we've used in the past, and they cost a few $100 to run that report, but they'll guide you through that analysis. And they'll tweak it based on your location and the size of your business and how long you've been in business, what your skill level is of these different things. Like, are you a junior? Are you a senior of these different things? But you can also do that same kind of thing, just more work. You can do it on you can go to salary.com or one of those other salary kind of places and figure out an equivalent market rate. And that, by the way, that also works for paying the kids, like we talked about earlier. Um, so, so that's why they do it, is because they think, well, I got to pay myself something, so I'll do 2,000 a month, and they take the rest as salary because it is more advantage tax wise. But that is not what you're supposed to do. So we'll leave that one there.
Do we got time for one more?
Let's do one more. Let's do a quick one.
Hope this one's quick. Are are there any good write-offs for people who work a regular job and have a side hustle?
Yes, it's not a quick question, but
Yeah,
yes.
it's not really
Okay.
the
All right. So yeah, it comes down to, once you have a business, it could be a side business, could be a main business. Either way doesn't matter. Um, you can start to apply some of these strategies of incorporating things that you were paying for that now have a business purpose. So like, home office stuff, phone, car, all that kind of thing. And there are rules to follow, and we don't have time to get into what those rules are, but there are rules to follow, and if you follow them, then you're entitled to deductions. The most important of which is basis. Basically, you have to have enough investment into your business in order to justify the deductions that you're taking. For a side business, it's usually going to work out that uh, your expenses are going to outweigh your income, and you end up with a net loss. And that net loss will carry through into your personal tax return. It will count against your day job income, and that will lower your income, and that will lower your taxes, which is great for taxes. By the way, it's terrible for buying a house. So if you're planning on getting a mortgage and using your taxes to qualify, then it's not so great for that. But these days there are more programs for small business type people, but you'll pay more in interest when you do that. Just be aware of that. Um, Banks like steady paycheck W-2 kind of stuff. They don't like business owners because business is volatile, right? Some years are good, some years are bad. So that is the short answer. So yes, side businesses are useful for defraying day job income, but yeah, beyond that, it's like we've got whole things on, we've got whole courses on just that, which we can talk about here for a second. So the question becomes, what's next? And the next thing is become an explorer. So go to taxsherpa.com/explore, or you hit the QR code there. That will take you to our explorers group, where you can find things like the starter course that goes into exactly that. It's actually got two branches inside the starter course, depending on if you have W-2 income from a day job or not, because there's different considerations if you're wholly self-employed or have your own business, or if you have a day job and a side business. So the same tax strategies are leveraged in different ways with different caveats and different concerns when you have those two different situations. So you can find that in the Explorers group in the Learning Portal. And that brings us to the end of today. So it is April 8th. So next week is April 15th. I kind of feel like we're not going to do a show on April 15th.
Me too.
Yeah, so let's put a pin in April 15th, and we'll come back on the 22nd, and we'll be a little bit more rested, and we'll be ready to tackle the rest of the year and help people make the best of their 2025 so they can pay as little as possible so that we can save $1 trillion, which is the mission of what it is that we do here at the Trillion Dollar Show. So with that, I'm Neil. We've got Fatma and Serena here. I'm going to call this the executive team. That's the new term. We're the executive
pretty
team
good.
here at Tech Sherpa, and we'll hope to see you in 2 weeks here at whatever channel you're watching on, YouTube, LinkedIn, X, anywhere that you're catching this. We'll see you then.
Right.
Catch you later.